In this video, we will establish why inventory adjustments are a necessary part of WFRP coverage using real-world examples. As mentioned before, a unique feature of whole farm revenue protection is that it doesn't rely only on what appears on a producer's tax return. Instead, it adjusts revenue so that it reflects what was actually produced during the insured year. There are several reasons these adjustments may be needed. Some commodities are produced during the insurance year but aren't sold until later. Other commodities may be sold during the insurance year even though they were produced in a previous year. Outstanding accounts receivable or money that is still owed to the producer may also need to be included. These adjustments help create a much more accurate picture of the farm's true production and revenue. Let's look at an example. An Idaho rancher has 100 beef calves born in April of the insured year, 2025. By the time the calves are weaned in October, they're worth approximately $1,500 each, giving the ranch a total value of around $150,000. Instead of selling those calves immediately, the producer decides to background them through the winter to add weight and sells them the following October in 2026. Even though the sale happens the following year, those calves were still produced during the 2025 insurance year, which is why WFRP may make an inventory adjustment. Let's compare what appears on the tax returns with how WFRP views the operation. Because no calves were sold in 2025, the producer's 2025 tax return reports zero calf sale revenue. The entire $150,000 shows up on the 2026 tax return when the calves are finally marketed. Without an inventory adjustment, the ranch would appear to have produced no revenue from those calves during 2025. With the revenue adjustment, however, WFRP recognizes that the calves were produced during the insured year and includes their value in the 2025 revenue to count. As a result, the operation's revenue more accurately reflects what was actually produced throughout the insurance year. Next, let's look at a crop example. Suppose an Idaho hay producer harvests 1,000 tons of alfalfa during the insured year. At $200 per ton, the crop has a total production value of $200,000. Before the end of the year, the producer sells only 400 tons, reporting $80,000 in revenue on the 2025 tax return. The remaining 600 tons stays in storage and aren't sold until the spring of 2026. As we know, without an inventory adjustment, WFRP would only count the $80,000 reported on the 2025 tax return. With it, however, the remaining $120,000 worth of hay still in storage is added back to revenue. That brings the farm's revenue to count to the full $200,000 that was actually produced during the insurance year. Remember, whole farm revenue protection is driven by production. Whether we're talking about calves, hay, seed stock, or replacement breeding animals, the goal is to accurately match revenue with the year the commodities were actually produced.